In a recent presentation titled Blood-Curdling Scream, Jim Rickards made a bold forecast about how the stock market will play out. Rickards, regarded as one of the world's best economists, stated that we may be witnessing one of the largest market corrections in our lifetimes. He even went so far as to claim that the markets just let out a blood-curdling scream, and that many Americans will suffer as a result. In this video, we will look more closely at what he said in the interview, and what he recommends you do to prepare for the coming months. First, Jim Rickards believes that the stock markets are currently in a gigantic bubble by any metric. He shows us a chart showing the market cap to GDP ratio to explain this. According to him, the market capitalization to GDP ratio is a decent indicator of how much money has been invested in the stock market in comparison to the size of the economy. He claims it is multi-billionaire Warren Buffett's preferred signal for anticipating market crashes. According to Jim Rickards, at the pinnacle of the dot-com bubble, the chart was at its highest point, and Buffett anticipated a fall. He was proven correct. For 15 years, the market did not recover. The indicator is now 113% greater than it was during the peak of the dot-com bubble, which Jim interprets as more easy money flooding into the US stock market than at any previous time in history. If this is taken away, the market will tumble even worse than the tech bubble. The margin debt chart is another chart he displays. The margin debt chart depicts the amount of money borrowed by investors to invest in the stock market. According to the graph, soon before the 2000 crash, margin debt reached around $500 billion as investors borrowed to invest in equities. Most people's debt-to-net worth ratio is increasing. Debt rose again just before the 2008 financial crisis as people leveraged their accounts. According to Jim, margin debt levels are at an all-time high today, with nearly $1 trillion of borrowed money floating around in the stock market, more than double what they were before the 2008 financial crisis, when the market fell by nearly 55%. And this excessive debt is cause for concern. They are also higher than during the trade war. As a result, he believes the ensuing crash will be one of the fastest and most violent correction in history. The last chart he displays is the Shiller PE ratio. The Shiller PE ratio, according to Jim, is a bubble indicator devised by Nobel Prize-winning economist Robert Shiller. It assesses how pricey equities are in relation to their earnings.